Hey folks, today I want to talk about the gold market. And even though the gold market has been lagging behind, it may not be time to write it off just yet. So that's what we're going to talk about in today's video: potential upside and defensive tactics using the gold market. Now, if you look at the gold market right now, this is the futures contract, and I just looked at a 1 year. This is a continuous contract. You will see that gold futures is hitting the 200-day moving average. That's not a positive sign. Typically, when an asset breaks the 200-day moving average, it is a bearish indication or an indication that bears are winning the war over the bulls. But in this case, gold has been in a very, very strong uptrend over the last year, or since this COVID-19 has been prevailing. And that's because gold is a very defensive asset. It's usually used as a hedge or as a defensive asset in case stock market prices go down. Gold typically spikes when stocks go down, and gold typically goes down when stocks go up. Now, the stock market has been very, very strong, but I'm seeing some cracks in the foundation that may cause either a short-term reversal or potentially even a longer-term reversal in the gold market. First, number one, gold is hitting right now. The RSI on gold, this is the 10-day RSI. This is an oscillator I use to measure whether price is overbought or oversold. And right now, although gold is hitting the 200-day moving average, the RSI is telling us that we are oversold. It's below 30 right now. It's at 29.04. And if you look right here, notice we were in a strong uptrend. Gold sold off. We saw gold prices go below the 200-day moving average for about 4 to 5 days. RSI went oversold, shook out the weak hands, and then gold rallied from there on. That'll happen a lot, especially if the stock market is becoming weak or is showing cracks in the foundation. Now, we are nearing New Year's. We've got Thanksgiving this week, and we've got the holidays, the big holidays, Christmas and New Year's, which makes up a lot of retail sales. And this year, remember, the country has not received any support past last few months. So there's very little money coming in, or spending money, consumer discretionary money coming in. So the country's not doing as well. As a matter of fact, retail sales went from 0.4% to 0.3% growth last month, with a warning that things are cooling off, not heating up. And right now, we're in the COVID climate. COVID is increasing right now, and there's no aid from the government. Unemployment still 750,000, so forth and so forth. But let me show you some other factors. And no, I'm not suggesting the stock market's going to go bear. No, but what I am suggesting is there's an opportunity here, and there's a possibility that the stock market's going to do a short-term reversal. This is the put-to-call ratio. This indicator tells us if stocks are overbought or oversold in the short term. And as you could see here, it doesn't usually go to 0.70, 0.66. It's usually actually a fairly random indicator. It's like a rubber band. And the only time a rubber band is really important is when you stretch it out. So when the rubber band is stretched out, you'll notice the put-to-call ratio get to 0.65. That means there's too many market participants becoming too bullish. That's right, too bullish. And if the put-to-call ratio gets to about 1.3, 1.2, that means it's getting too bearish. But right now, we're near the 0.65, and that's telling us that bulls are really driving this market too much. And when typically the put-to-call ratio gets too high, it tends to reverse. So I am seeing that potentially happening right now. Moreover, in light of that, look at the NASDAQ 100. First of all, price has been just going through the roof, and it has been underperforming. The NASDAQ 100 caused too much upside too quick first half of this year since COVID, stay-at-home stocks, so forth, so forth. The FANG stocks have been doing really well, but they're not doing all that great right now. And if you look at the stocks, they've been underperforming the small caps. And if you look at the NASDAQ 100, this is the number of stocks above the 200-day moving average. This gives us a broader way of looking at stocks. You will see that 85% of stocks in the NASDAQ 100 are trading above the 200-day moving average. That's nosebleed level, folks, and that's telling us markets are overbought. If you look at a 20-year level, look where we're at. We're talking 85 stocks, literally out of 100, are trading above the 200-day moving average. If you look at the S&P 500, look at this. This is nosebleed levels. 88% of stocks are trading above the 200-day moving average. And again, on a 5-year basis, we're at the highest level we've been in 5 years. On a 10-year basis, we're almost at the highest level we've seen since 10 years. So the market's really, really overbought. And it typically, when it gets this overbought, and when the put-to-call ratio gets to 65, the market bounces off. And when it bounces off, guess what asset rises? Gold. That happens to be approaching oversold. So gold is approaching oversold territory, and the SPY, the S&P, is becoming crisply overbought. Look at this. And the NASDAQ, QQQ hasn't been as bad, but let me show you this. Overbought. It's at overbought levels right now. Look at that. So again, I'm anticipating a cool off. Look at this. NASDAQ 100 hasn't been able to take out its September 2nd high. That's not pretty. So what I'm expecting is a minor sell-off, potentially the S&P or the QQQ, doesn't matter which one. They're both gonna go the same way. But I'm expecting the S&P, to cool off and go to the 50-day or possibly the 200-day moving average, maybe even before the end of this year, and shake out the weak hands before going higher. And if that happens, gold, this asset, is going to do exactly what it did here and rise above and start spiking, especially in light of the fact that it's oversold right now, with the stock market being overbought, not just on a technical basis, but on a put-to-call ratio. That's sentiment. That's the NASDAQ 100. Look at this. We're at nosebleed levels here. And the S&P 500. And that's actually very positive for gold. Maybe not in the long term. In the long term, gold would have to really rally above the 190, 195 level. Don't know if we're going to get there, but we're right now at 168, 169, and there's a good chance that gold will bounce to the 185, 190 level if the stock market takes a little dive. Now, let me show you something even more interesting. Look at this stock. This is Sibian. I can't pronounce this. Sibania Gold. Sibania Gold. If you know a better way to pronounce it, let me know. But ticker symbol, that SBSW, Gold, Silver, Ores Limited. It's Sibani Stillwater Limited is a precious metal mining company, right? They mine. Look, let me show you this. Look at this prices. Look, we're above the 200-day moving 50-day moving average. We're still bullish. We just made all-time highs a few days ago. How about this one? Sierra Metal stock, metal mining company, Bohr Metals, precious and Bohr Metals. Guess what a precious metal is? 112% this year. Look at the price of this. Look at the technicals on this stock. Look at this thing. Does this look like a bear market to you? This thing is like literally making all-time highs almost every day. So my point is, if GLD, if gold takes a dump, if it bounces back up after taking this dump, what do you think it'll do to the gold stocks that are actually making new highs while the gold is going down? These things will rise. It's going to be another level. So pay attention to that. So don't rule gold out quite yet, especially if there's a little downside on the stock market. And it wouldn't hurt to have a little gold in your account as a hedge, so you don't have to liquidate your stock positions, and you could just remain neutral and not have that that tax liability for capital gains. So just a thought. I'm just throwing things out there. Gold is a very, very good hedge. So if the stock market takes a dump, these gold stocks are going to start rising. That's right. And gold, that's at the 200-day moving average with the RSI at the 29 level, it's going to bounce. Just something to pay attention to. Now, folks, I've got something important for you. This 29 market veteran, this guy's been at it for 29 years. He just made a gold prediction. He's claiming enormous profit opportunities brewing in the gold market. Imagine that. I'm not the only one. No, this is not me. This is someone else. And this guy's been around the block 2 years more than me. the likes of which haven't been seen in over 20 years. He's calling for a bull market. Look at these gold stocks. People who put even a small sum of money into the right gold stock today could see their investment multiply many times over. This Sierra Metals is a $3 stock. Given today's rocky political climate, nonstop stimulus money getting injected into our global economy, gold is becoming one safe haven in sea of growing uncertainty. Man, this guy's singing my song. He's playing my game. This is exactly what I'm talking about. You got to check this out. This is some really, really good stuff here. Really good stuff. This is a trading veteran. He knows what he's been doing, and he's talking about some bullish opportunities in the gold market. Imagine that. Click the link below, learn about gold, and why one expert is calling it can't lose commodity. I can see why. Look at this SMTS, SSBSY. Man, I got to check this out. Follow the link below. Don't miss out. It's good to get a second opinion, right? Talk to you guys soon. Bye.